What exactly does the new tax legislation mean for the commercial real estate market, and how could it potentially reshape investment strategies? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a landmark move, Congress has passed the One Big Beautiful Bill, a comprehensive legislative package expanding on the 2017 Tax Cuts and Jobs Act. This bill introduces significant changes to the tax landscape, offering powerful incentives and long-term clarity for commercial real estate professionals and investors. According to Latitude Commercial, this bill is set to create a major impact on the sector. The One Big Beautiful Bill includes a permanent extension of key provisions from the Tax Cuts and Jobs Act, a $4 to $5 trillion increase to the debt ceiling, expanded tax breaks for families and businesses, and rollbacks of clean energy incentives. Additionally, it introduces stricter eligibility requirements for Medicaid and the Supplemental Nutrition Assistance Program. This sweeping legislation touches on various aspects, including estate taxes, standard deductions, opportunity zones, and bonus depreciation, making it one of the most impactful fiscal measures in recent memory. For commercial real estate, the key provisions are particularly noteworthy. The restoration of the 100% bonus depreciation allows assets acquired and placed in service after January 19, 2025, to be eligible for full first-year expensing. This reverses the previous phase-down and reintroduces a major incentive for capital investment. Moreover, opportunity zones have been made permanent, facilitating long-term planning in designated areas. The qualified business income deduction is now permanently set at 20%. And the estate and gift tax exemption thresholds have been raised to $15 million for individuals and $30 million for joint filers. Additionally, the state and local tax deduction cap is temporarily increased, allowing joint filers under $500,000 in income to deduct up to $40,000. Latitude Commercial views this bill as a green light for increased activity across acquisitions, renovations, and tenant improvements. The return of full bonus depreciation is particularly impactful as it boosts after-tax return on investment and enhances financing outcomes. With the 100% bonus depreciation back in play, cost segregation studies become more valuable. Identifying short-life assets, such as 5, 7, or 15-year property components, allows investors to fully expense those items in year one, creating substantial tax savings. This strategy is ideal for new construction or acquisitions in 2025 and beyond, as well as renovated commercial buildings and tenant improvements. Investors aiming to reduce current year federal income tax obligations will find this particularly advantageous. Other tax incentives to watch include Section 179D, which is still available but set to be repealed for construction starting after June 30, 2026, and the Research and Development Tax Credit, which remains in effect with a temporary reversal of Section 174 rules, allowing full deductibility of domestic research and development expenses. With this legislation now in place, commercial real estate professionals have a stable and favorable tax framework to work within. Latitude Commercial is ready to help clients take full advantage of these changes, whether through strategic acquisitions or long-term planning in opportunity zones. As always, it's essential to stay informed and prepared to navigate the evolving commercial real estate landscape with confidence. USA REIT Markets has launched a revolutionary blockchain trading platform for commercial real estate securities, addressing the industry's greatest challenge: liquidity. The platform allows investors to buy, sell, and trade their positions with daily liquidity, eliminating the traditional 5 to 10-year lockup periods. By utilizing blockchain technology, and SEC-compliant exemption frameworks like Regulation A+ and Regulation D, USA REIT Markets significantly lowers the barriers to entry, with a minimum investment of just $1,000 compared to the industry norm of $25,000 to $50,000. This opens access to institutional-grade commercial real estate deals for both accredited and non-accredited investors. Brian Smith, Chief Executive Officer and founder of USA REIT Markets and Capital Engine, stated, "We're democratizing access to premium real estate investments while solving the industry's most persistent problem, illiquidity." The vision is to create a dynamic secondary market for private real estate investments where capital moves freely, efficiently, and compliantly. To support its next phase of growth, USA REIT Markets has appointed Laura Hamoen as Chief Operating Officer. Hamoen is a recognized leader in real estate tokenization and brings deep expertise in blockchain compliance, investor onboarding, and PropTech innovation. She will oversee platform operations, deal onboarding, and strategic partnerships with sponsors, broker-dealers, and advisors. "I'm thrilled to join USA REIT Markets at such a pivotal moment," said Laura Hamoen. "Our platform is poised to redefine how commercial real estate is accessed, funded, and traded, offering unprecedented transparency, compliance, and liquidity for both investors and issuers." Backed by the Capital Engine technology stack, USA REIT Markets has already demonstrated strong momentum, with over $750 million raised across platform partnerships and over 10,000 investor accounts in the network. The commercial real estate pipeline underway is valued at $650 million, with a projected 78% compound annual growth rate in revenue over 5 years and a break-even forecast in year 2. Redevco, a privately owned European real estate manager, has launched its first closed-ended Redevco European Retail Parks Fund. This fund focuses on acquiring and managing high-quality, convenience-led retail parks across Europe and the United Kingdom. With a commitment of €500 million from CBRE Investment Management, the fund is seeding 2 retail parks in the United Kingdom and 3 in Belgium, including the Ustacker Teerlink Retail Park in Belgium. This strategic move by Redevco highlights their aggressive expansion in the European retail sector. By focusing on convenience-led retail parks, Redevco aims to cater to the evolving shopping preferences of consumers who are increasingly seeking accessibility and ease in their retail experiences. For the commercial real estate landscape in Kitchener, Waterloo, London, and Cambridge, Ontario, this development provides an interesting comparison. While the focus in these areas may not be on retail parks, the emphasis on convenience and accessibility aligns with trends in multifamily and tenant leasing projects, where proximity to amenities and transportation is key. In the United States, this strategy could translate to the development of commercial spaces that prioritize ease of access and consumer convenience. The American commercial real estate market, particularly in urban areas, has seen a similar trend where mixed-use developments and retail spaces are integrated to provide a seamless experience for tenants and consumers alike. By committing to such a significant investment, CBRE Investment Management is reinforcing the potential growth and value of retail parks in Europe. As the commercial real estate market continues to evolve, strategic investments like these could offer insights into future opportunities, both in Europe and North America. Developers in Tegakay are embarking on an ambitious project to create a vibrant new main street with a budget of $250 million. The project, which is set to unfold over 3 phases, is expected to take 5 to 7 years to fully develop. This initiative aims to transform the area into a bustling hub of activity, offering a mix of retail, office, and residential spaces designed to attract both businesses and residents. The development is strategically planned to enhance the local economy by drawing in new businesses and increasing foot traffic. The project's design focuses on creating a pedestrian-friendly environment with ample green spaces and public amenities, ensuring a welcoming atmosphere for visitors and locals alike. This extensive undertaking reflects a broader trend seen in various regions, including Kitchener, Waterloo, London, and Cambridge, Ontario. In these Canadian cities, similar mixed-use developments are gaining traction, emphasizing the importance of accessibility and community engagement in urban planning. These projects are designed to integrate living, working, and leisure spaces, providing a seamless experience for residents and visitors. In the United States, this approach resonates with the growing demand for mixed-use developments that prioritize convenience and accessibility. As urban areas continue to evolve, the integration of commercial and residential spaces becomes increasingly significant, offering insights into future opportunities for developers on both sides of the border. The Tegakay project is expected to serve as a model for future developments, showcasing the potential of thoughtfully planned urban spaces to revitalize communities and drive economic growth. As the project progresses, it will be interesting to observe its impact on the local real estate market and the broader implications for similar ventures in North America. In 2025, the landscape of shopping developments is evolving as developers aim to attract high-profile brands to smaller markets and older shopping centers. According to Melissa Daniels, reporting for Modern Retail, this shift is partly due to the vacancies left by former retail giants like Joann, Party City, and Rite Aid. The increase in retail availability, as noted by CBRE, rose to 4.9% in the second quarter, driven by retailer bankruptcies and footprint reductions. Greg Lyon, chairman and president of Nadal Architects, emphasized the need for retail to continually reinvent itself in response to these changes. A significant trend shaping retail real estate in 2025 is the adoption of mixed-use developments. Lyon pointed out that developers are now favoring amenities like putting greens, virtual reality experiences, and pickleball courts over traditional anchor tenants like movie theaters. Open spaces are also being monetized as they increase visitor numbers and the length of stay. Najla Kayem from Kayem Marketing highlighted the importance of property owners tapping into diverse services such as urgent care, med spas, and gyms to fill vacancies and cater to the evolving consumer demands. Redeveloping vacant spaces is another strategy being employed. Developers are carving up large, empty box stores into smaller units or transforming them into food halls. This approach, while challenging, involves adjusting electrical systems, signage, and parking requirements. Nadal Architects is also exploring the optimal size for retail footprints to ensure sustainability and performance. However, these improvements require significant investment, especially in the current climate of high interest rates. Smaller markets are showing potential as viable locations for retail expansion. Cities like Manteca, California, are experiencing growth due to their affordability compared to larger cities. Manteca is projected to have 100,000 residents by 2030 and has attracted businesses like IKEA and Chick-fil-A. The city is investing in projects like the Fez, a 150-acre family entertainment zone, to capitalize on nearby attractions and boost commercial real estate activity. The article also highlights the advantages of working with smaller cities, such as faster permit processing times. Fairfield, California, for instance, processes permits in 60 to 90 days compared to the 8 or 9 months it can take in Los Angeles. This efficiency can be a significant draw for businesses looking to establish a presence quickly. Jermaine McMahelk from Newmark Merrill emphasizes the importance of building relationships with property owners and communities early to ensure successful developments in undersupplied areas. As we see these trends unfold, it's clear that the commercial real estate landscape is adapting to new consumer expectations and economic realities. Developers and brands must remain agile and open to innovative strategies to succeed in this evolving market. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.